Okay, it's Saturday, 5th of April 2014. Hope you're enjoying your weekend. Hope you had a great day's trading on Friday. What a day Friday was. Huge downtrending day. NASDAQ got destroyed. And it was good for day trading. It was nice and fast and smooth. We had a nice little sell-off first thing, a little bit of a weak bounce back, and then the real trending move kind of set up, and we had a huge kind of down day. Don't want to talk about the day trading kind of opportunities specifically. I want to talk about the bigger picture because we had a crash warning signal go off last weekend on commitment of traders, and I've got a whole bunch of emails, people asking me to talk to that. But before I do that, I want to talk to distribution days, and I want to talk about James's emails I've been getting over the last couple of weeks. I highlighted one of these a couple of days ago, just talking about these kind of distribution days. And according to James, on his count, we now got day 6 distribution day on the NASDAQ, which for him is an extremely important number. That was the magic number he was looking for in terms of distribution days, and we got it with Friday's activity. I've got a slightly different take on distribution days, and I'm going to show you that on this better volume indicator on the NASDAQ chart. And I want to specifically look at high volume churn days. So this is NASDAQ index daily chart here, and we got better volume below the price bars, and we got better volume paint bar on the price bars, but the only bars that I've highlighted here are the high volume churn bars. Now on the histogram, the volume churn bars are in green. On the price bars, they're on blue. For whatever reason, historically, that's what I ended up doing. It doesn't make sense at all. Apologies if it's confusing. But what I'll try and do is explain what a high volume churn bar is. It's a day where we get relatively high volume and relatively low range. And as we're making new highs, you can see in the tops or bottoms, but this is the sequence I want to talk to here. As we broke out to new highs back in February on the NASDAQ, we were making new highs here, but there was sellers kind of coming in. They were meeting all of those buyers who were buying the breakout move to new highs, and they were coming in and compressing the range. So they were adding to the volume, they were kind of keeping the price kind of contained within a smaller range, and what you end up with kind of is a little bit of churn. So new sellers kind of coming in, compressing that range, and that's what you get. So we've seen a couple in the past, kind of back here and back here, but this whole sequence of 1, 2, 3, 4, 5, 6 going on here into those new highs just shows that there's selling pressure kind of coming in here. And then lo and behold, this week we came back up to test, and there on Wednesday was that high volume. You can see a high volume churn bar, green on the histogram, blue on the paint bar. The range is tiny, the volume's high, so that shows churn coming in there, and that's almost like a last roll of the dice. Professionals kind of coming in here, meeting all of the buyers there, trying to buy, in anticipation of breakout to new highs. No, they're coming in there, they're meeting all that buying pressure, keeping the range compressed, and then, at the end of the week, we're back where we started at the beginning of the week, actually a little bit worse on the NASDAQ, and bang. So we kind of sold off there. For me, what's really important is that we've broken the cyclical support, the daily support, and closed below it on the NASDAQ chart, and that's the weakest of the lot. For me, that's really significant. Sometimes we get little overshoots of support here. So for example, this support you could argue was just marked a day or so early with that little kind of false kind of rally day. Then we came back and tested, and really this support would have been better placed kind of down here. So it was a little bit early, and we got a little bit of overshoot to the downside, and we bounced all the way back up. But you can see the amount of strength that we had after that was like it was a false day, and then we're better off kind of placing that support kind of further down here. What's different about the way we broke this support on the NASDAQ chart on Friday was that daily support was well in. We were moving away from that nicely. We'd had several days kind of rally going the other way, but then mid-stream, mid-cycle, going from support to resistance, all of a sudden they've decided, no, that's enough, we're going the other way, and we're starting to break into a trend move, closing below support on the daily chart on the NASDAQ. And if this continues down next week, Monday, Tuesday, Wednesday, it's breaking into a downtrend on the NASDAQ daily chart. So that's really important. We've still got a support on the weekly chart on NASDAQ to put in at some point, but this could turn into a nasty trend move on the way down, and that's the significance of this. If it was just a little blip up and then kind of overshoot on the downside, and that looks kind of should have been placed kind of down here and we rally. Different. This was well in That support level was nicely kind of confirmed. We had 3 or 4 nice days of strength away from that, and then they decided no, whoops, going the other way. So let's wait and see. Continuation we need kind of on the way down, kind of breaking it on the way down. Still on the 45-minute chart, I'll show you in a second, we still need to put in some kind of support resistance move, but that for me is very significant. When we look at this on kind of a momentum chart on the NASDAQ here, we put in exhaustion, first bearish divergence and flush patterns right at the high up here, and now the buying has been really weak on these little kind of right shoulders, really weak, and so this move, bang, kind of testing down. Similar type patterns on a lot of these kind of indices where this last buying leg was pretty weak. We had our exhaustion buy and bearish divergence, this one kind of coming back. Cyclical resistance on the S&P 500s there. On the Dow, cyclical resistance kind of come in, weaker buying after our bearish divergence close to the zero line, kind of coming down. So the momentum's kind of starting to flip around, but that closing below that support on Friday was a big deal for me. Better X trend has also kind of started to flip around. So a few days ago we had this last kind of move and it kind of broke back up on some of these time frames, but this is the S&P 500, bang, exhaustion sell day, and this is what James is referring to here. Today's exhaustion volume on the S&P mini that gets the down move going. I guess it is. So that's exactly how I'm interpreting it. This is kind of the move getting it going. Like here we had getting the move going and then ending the move. So this is the volume that kind of gets this move going. Maybe this one here kind of selling it down, and then it capitulates and we kind of have the exhaustion move and we bounce from there. So this is because it's happening at the top of the range, it's kind of getting this thing going. What's the next one over here? NASDAQ, same thing. So the NASDAQ has been weak all along, and this was a little kind of weak breakout, back up, kind of flipping this trailing stop, better X trend around, and now we kind of had continuation on the way down. So let's see that kind of broken Monday. Tuesday, I'd see that going. It wasn't an exhaustion sell on the Dow, but you can see we've broken, so the trailing stop has now flipped around to kind of be following us down. Just on the 45-minute chart, so what I'd like to see, daily chart here, here's the resistance kind of comes in, 2 time frames down, is the 45-minute chart. Remember, there's this factor of 3 happening. 3 times 45 is 135 minutes. 3 times 135 gives us 405 minutes, which is the number of minutes in a daily bar. So here I like to see an end of trend move that syncs up with that cyclical resistance on that daily time frame. We got cyclical support to kind of put in here. We did break into an uptrend. Whether this is just going to be a weak support to resistance, but let's see. I'd like to see a little push back up. I'm not sure whether Monday will just kind of continue straight down. We just might have a little bit of support to resistance to run out on the 45-minute chart here, because we got this cyclical energy to basically dissipate on this 45-minute chart. And once that resistance line kind of comes in on 45, we'll have a triple. We'll have resistance on 45, resistance on 135, and on the daily chart, and that'll be interesting to see what kind of happens after that. So there we go. That's kind of bigger picture distribution days, high volume churn days, and so on. Now, this is what I'm getting emails about. This is the crash warning indicator using the commitment of traders numbers. Don't use on the commitment of traders. I'll put up a link to the commitment of traders article because I do think it's worth kind of referring to, and specifically on this indicator because you can get its free code on the site. The E-mini commitment of traders numbers. The E-mini has become the de facto, however you say it, day trading vehicle. And it is not a position taking vehicle. Position taking happens in the S&P, and this is SP.P, which is the TradeStation symbol for the SP, the large contract. The volume, I've been talking about this over the last 6 months or so, the volume that's traded now through this contract is really small. It used to be the go-to kind of futures contract 10-15 years ago. It is not any longer. The E-mini is. So I'm less convinced about its kind of prediction kind of capability, but it is still very interesting. So this is a crash warning signal that kind of came out with last weekend's numbers. Now, last weekend's numbers, what I put on this chart is just the straight commitment of traders looking at the professionals. So this is better COT, better COT for commitment of traders. It's not flipped upside down or anything like that. This is straight way. If it's negative, that means the professionals are net short. If it's positive, they're net long. Now, let me just turn one little thing on for you, which is the change in the reading of this from week to week. And you can see the change that we had, not this last weekend, but the weekend before, going from this reading, which was positive 8.4 to negative 24.4, was a net change of 32.8 points, percentage points. That is the biggest change that we have basically ever had in a week from here to here. I was reluctant to talk about this last weekend because I didn't know if this data was spurious, whether it was just glitchy. Bear in mind, you know, the way that the professionals are identified by the in the data could have changed, and there are various points kind of historically in terms of, you know, the commitment of traders data where we've had big jumps in the data, and who knows, like, you know, I don't think they give the details of the classifications of the professionals, you know, versus, you know, the hedge funds and trend followers versus the remainder. So I don't think those names are kind of out in the public, so people can understand if there are changes in kind of allocations going on, buckets of trades going on. So that's a possibility that you can get with kind of a big change like this, and that could be part of the picture. Part of the picture could be that, but you know, the point is that we've kind of had a huge kind of reversal in this, and it's generated a signal. So take it with a grain of salt. If someone has kind of better information about the classification of players within commitment of traders for the SP contract, please let me know. If I'm kind of off base or don't know something that's kind of going on, I'd really appreciate a little bit of insights there. In terms of the net reading, though, you know, it's not unusual. It's a big reading, obviously, but it's the change week on week that was so kind of extreme kind of going on here. Now, the commitment of traders crash warning indicator came about through looking at this plot and saying there was these funny kind of anomalies that happened around the zero line. When you had changes happening around the zero line, with the professionals kind of flipping from long to short and short to long and so on, it tended to be around areas where the market tended to sell off. So on this chart, looking back to 2003, you can see the warning indicators kind of go off, and then I've got corrections and crashes marked on the chart. So a correction is kind of defined as a 10% move from the highs, and a crash is 20% plus move from the highs. So this is 07-08, where we had first of all corrections, a couple of corrections, and then leading into the big crash in 08. And then subsequent, we've actually had a couple of corrections kind of going on. This was actually a little mini crash that we had in 11. That move down was almost to the number, 10% down from that little high there, and we kind of rallied on. Now last year we had a couple of false signals kind of going on, and we kind of continued to rally to new highs. I was kind of thinking there was a lot of kind of reasons why we might kind of sell off there. We didn't. But this is the way the indicator kind of works, and I'll try and explain what's kind of going on here. So as the market starts to rally, and this is just my interpretation of what's going on, what I'm saying is that there's an anomaly that happens around the zero lines that's quite interesting, that happens around periods where we get kind of corrections and crashes, and I'm trying to understand what's going on. So most of the time, you know, this vehicle, this futures contract, is being used to hedge. So as the market in leading up to 2011, 2010 here kind of advances to new highs, you can see the commitment of traders numbers are increasingly negative. So that means that they are increasingly shorting this rally. So they're hedging as the rally kind of continues. But then as the rally kind of continues on to new highs, they start to take off their positions. They start to reduce their net short exposure, and they end up going long, just fractionally, just for a little bit of time here. And then they start to, what I interpret as, instead of hedging here, they start to take, I can hear my roosters going off in the background thanks to yeah, it's 5 p.m. here on the island of Kauai, so all the roosters are going nuts, as they do at 4 a.m. as well. Anyway, so as the market kind of has made new highs here, I interpret them increasing their short positions here as they're starting to take directional trades. So while the rally was happening, they were happy to increase their hedges, but then once they see the market starting to top out, they say, well, why not jump on board and actually make some money with a directional play? So they start kind of playing directionally here. So while we have that little correction crash move, they're negative into this, and then as the market kind of bottoms out, they go long again, and so they're continuing this direction play. They've been short and now they've been long, and then as that move kind of starts to become a trending up move, they start hedging again. So they're hedging, increasing their hedges here, and then they start taking their hedges off as they see a little opportunity for a directional play. They're short just a fraction here during this move, then they start playing directionally again until they're seeing a longer term move, and so then they're hedging again and again. So I hope that makes sense. That's what my interpretation of what's going on, because these changes around the zero line here, where they're taking off their shorts and then going short and then going long, seems to be a directional play that happens around these kind of market corrections and crashes. The last couple didn't work out well. So we were making new highs here. They started taking off their shorts. Initially they were long for a fraction of time here as they'd reduced it, and then they got directionally short. And they did it a couple of times here. They got a little bit long, and then they started hedging again. So these two didn't work out. So this last little setup, we've been making new highs. They've been short. Remember, the data around December here was whack on the commitment of traders, and these bars should be different bar by bar, but they are identical, and TradeStation still hasn't fixed this data. And as we're kind of, they're seeing an opportunity to take off their hedges. They're going a little bit long here, just like they did here. At this kind of high here, they've taken off all those hedges, and then all of a sudden they've kind of gone short. So they're playing kind of a directional play, not unlike this kind of move down as they kind of go short. So that's the trigger, and you can get the code on the site. It needs the hedging to be happening as we break to new highs, new 52-week highs, for them to reduce their hedges and go fractionally long, for a week, even a week or two, and then they start kind of going short, anticipating a trend move kind of breaking down. So that's the logic behind it. It's signaled here this last weekend on an extremely high kind of net short reading, kind of down here by the professionals. So I'm putting it out there. That's my interpretation of it. Whether it'll be good or work out, I'm not sure. But if you put in context, this kind of breakdown, close below a daily support on the NASDAQ chart. If this does continue down and we break into a trend move on the daily chart here, having seen these kind of distribution days or high volume churn days kind of going on here, that could be interesting. So I suppose in my voice you can hear a little bit of lack of confidence in making a call. I've been so bearish this entire thing because I fundamentally disagree with the way the Fed has played this. It's worked out, for now. We have, to all intents and purposes, saved the banking system. They've been protected. But the net result is we have no less debt in the system, and we have no less bad debts in the system. It's like they're still sitting there on balance sheets, and we've still got people out there with way too much debt. So if we just set ourselves up for more trouble kind of in the future, instead of clearing the system, getting this thing out and getting back to reasonable interest rates. And this whole 4-year, 5-year period, we have had savers who are the sensible people in the market, have been subsidizing to the tune of trillions of dollars, everybody else who's been essentially saved by the system. So I haven't liked the rally. I've not liked the rally all along, but every time I've said this is it, we're going to have a large correction or whatever in the last year and a half, it's not worked out that way. So I'm just been burned a couple of times, so I'm just holding back. I'm just not as convinced. But if we start breaking down through this daily support and we break into a trend move on those daily charts, then we could get some travel. We got stuff in the background to say there's some kind of exhaustion and lack of momentum kind of going on. Let's now see price kind of confirm and get this thing going on the downside to get a confirmation that's change kind of going over. So there we go. Hopefully that was useful to you. You'll probably be seeing it on a Sunday evening maybe. Anyway, let's see what happens Sunday evening into Monday's trade. Should be interesting.